David, how are you feeling now about the markets and about the Fed's chances of this soft landing? I mean, he's not saying I feel really confident that we can do it, but he's saying, yeah, maybe. We're still hoping.
Yeah, I think his message has been very steadfast, and I don't think there's much that changed here. He really does believe that maintaining that inflation anchor on long-term inflation expectations is the #1 goal. I think Loretta Mester also made her speech in a very similar vein, maybe a little bit more forcefully. And I think that's where the Fed's head is. It was good news that the Michigan survey revised down those long-term inflation expectations from a 15-year high. So I think they'll take some comfort from that. But nevertheless, look, we're on high alert for any signs that longer-term inflation expectations are unanchoring, and I think they're going to be quite vigilant against that, and it's going to hurt a little bit. I mean, they're going to have to do QT, they're going to have to tighten, and we're going to have rates of 3% in the front end before you know it.
And Alicia, is that why you still seem pretty confident that the bottom is not in? And is this more like a bottom isn't in, but don't try to find a bottom anyway, and you're dipping in and think that people should be looking for bargains here, or the bottom isn't in yet, so stay away for a bit until we get some better signal?
Look, just a couple of things. First, on Jay Powell, he's signaled in the last couple of speeches that he's willing to risk the recession because fighting inflation at this point is the priority, because you can't run an economy with high inflation that is ongoing. So the Fed is willing to risk a recession. And in fact, the ECB said the same thing today as well. The reason we think the bottom is not in is not simply because of the Fed, also quantitative tightening, which we haven't talked about, but also because the earnings estimates really have to come down first. I mean, that's our signal really to where we would be interested in adding risk here, because we do think there's a slowdown. We're probably in the slowdown now. And until we really see some realistic earnings coming out of the sell side, we're just kind of waiting for that to happen. So, because once Alicia, that starts, then you can get back in, because then you have a realistic place on valuating companies.
Well, what's that going to look like? Is that going to take a shock? I mean, from earnings and guidance, where companies have still been saying, well, the second half is going to look better, it's going to look better, and then eventually they're going to have to admit, if this is the way it pans out, that it's not, and we're all going to have to feign surprise. I mean, nobody on a macro basis seems to think, right, that things are getting that much better, but on a micro, independent, individual company basis, nobody sort of wants to admit it.
Look, it's hard to believe that the second quarter earnings are up 4.5% on estimates, and the second half are going to be up 10.5%. So that's not believable. I think what we're hearing from companies now is that they're getting hit on the margin. And as we've talked about, the margin was also increased as a result of the fiscal stimulus. So if you think that everything's going back to where it was before, the historically high margin has to come down as well. That's why you'll see lower earnings. So we think we're sooner to that than later, and that's why we're saying the bottom's not in. In addition, the Fed is really boxed into going 75 basis points in July, simply because there won't be enough data between now and then to really convince the Fed to go any lighter on that. So if you add it all up, it's a tightening Fed into a slowing economy with earnings that are way too high.